Yo, what's up, guys? It's your boy Looney, and today I'm breaking down one of the simplest rules I use in my investing strategy. And this rule has helped me avoid buying tops, avoid chasing hype, and avoid stressing every time the market dips. It's not about timing the market, it's not prediction, and it's not some secret indicator. It's just one simple rule, and that is that I only buy when the market is in fear. And to even go on top of that, I only buy if it's below my average cost basis. So let me break down exactly how that works. But before I do, quick shout out to the Discord. It is free to join. And I also offer a premium membership for $8 a month. And you get access to one-on-one coaching, trade callouts. I have an option selling course. I do giveaways and more. You can check it out. All the links are down in the description. So most beginners actually do the opposite of what they should do. And they end up buying when the market is green, they buy when stocks are trending, and they buy when everyone on social media is screaming, "We're so back." Now, I am guilty of this myself, and the most recent is Opendoor. It isn't that negative right now, but I bought it pretty high. Some people were buying it in the $2 and $1, and I bought it in almost $8 or $8.50. And we could see that I'm not even following my own rule, or at least in this scenario, I'm not following my own rule. And therefore, we all make mistakes. But if you do this or this kind of scenario, that's how you end up buying the top. And when stocks run up, the premiums for selling options, it's tough, the fear disappears, and people forget that dips even exist. And that's when I personally wait. Like even right now, even though I am negative, I am waiting. I mean, there's no need to buy more at these prices. If I already bought in and I'm slightly negative, I'm not that negative, but overall, there's no need to be buying at these levels for myself. I'd rather wait for a bigger pullback. So when buying during hype is kind of how you trap yourself in a bad entry. Another example we can look at is Riot. Riot's a really volatile stock. I own it, and we can see it's down 37% in just the past month. Now, I did buy it at $9, but there are some people that did buy the top. They bought it at 22, 23 when it was soaring, when it kind of seemed like there was no way for it to go down. And that's how you get caught. You get caught bag holding, and you end up losing a lot of your money, and your returns are really negative. So when this happens, buying during hype is kind of how you trap yourself in a bad entry. So instead, I try to flip the entire mindset. And my simple rule is I just buy when there's fear. And if the market is scared, I buy. And also, if the price is below my cost basis, that's even better. I was just showing you Open. It wasn't that negative, so I'm not really buying that one. But an example like Webull. Webull's a newer position I opened, and I bought it at the $11, the $10, and I'm still negative. So I'm buying at the $9. Sure, it can go all the way down to $5. It can go really low. And that's unfortunate. Of course, I don't want it to go down that low. But if it does, I'm prepared to dollar cost average in. And you can even do it with selling options, as this is one of those examples. But fear actually gives you opportunity because it gives you discounts. And discounts give you safety. Safety gives you room to survive the volatility. Now, you could do the same strategy with safer stocks like Google and Amazon. I'm showing you more volatile stocks just to show the extremes of this situation. But that doesn't always mean just buying the shares. I'm also talking about selling puts as well. I went over that example there. Yes, you can just buy the shares when they're negative. I do it on stocks that are a little bit more pricey. So something like Hims, for example, I can't really afford to sell options. I mean, I can, but I don't want to be putting up all that capital. So instead, I'll just buy small amounts, dollar cost average, and just buy shares outright and lower my average costs. So with selling options, you're basically saying you're willing to own the stock, and then you sell a put below either your average cost or below the current strike price. And I did that exactly with Webull. That was my example. If the put expires worthless, meaning the stock is trading above your strike price, you get to keep that premium and you realize that gain. And you make money for basically just waiting for your option contract to expire. Now, I'm doing this with Riot, I'm doing it with Webull, I'm doing it with Zeta. I am diversified on that note. These are going to be some trades, so if I do get assigned, I'll probably end up selling covered calls And it works the same way, covered calls, but instead of using cash to do the trade, you need to put up shares to do the trade. And that one, you don't have to worry about too much with your average cost. I mean, yes, you do. When you sell calls, you want to be selling calls that are above your average cost. So you do want to worry about your average cost, but this isn't like a buying strategy, I guess. Selling covered calls isn't really a buying strategy. And on the other hand, going back to the fear, when the price is under my average cost and we're in fear, that is definitely my green light to start buying either shares or selling puts. Now, I'm not going all in. Yes, I know the market is pretty elevated right now. And I mean, there's a chance for an insane pullback or a crash or recession. There are chances of this, but at least I'm prepared to buy up the shares at a discounted price. But this is how the rule actually removes emotion, because that's very important. This simple rule does two things that beginners often struggle with. It tells you when to buy. You're not just chasing green candles. You wait for fear. You're looking at VIX, for example, for knowing whether volatility is elevated. You're waiting for red days. You're waiting for that panic sell-off, those big dips. And it tells you where to buy. You want to be doing it below your cost basis, not above your cost basis, and obviously decreasing your average costs. And that alone filters out. It filters out FOMO buys, chasing breakouts, buying at inflated valuations, and getting stuck bag holding those type of hype pumps. Again, I can show you another example with Beyond Meat. This one shot up all the way to $7 at some point, I believe. Let me try and find the 3-month. Yeah, it shot up pretty significant. I think it's only showing, okay, there we go. It shot up almost $7 at one point. And I didn't buy at these prices. I bought at $1. Now, I'm barely positive on that note, but you can see that I can afford these massive sell-offs and dips. But most people end up losing money, not because the market hates them, but it's because they buy during excitement and panic during fear. So my rule, I believe, flips the script. I buy the fear, not excitement. I buy value and not the hype. And I use this with options. Options is a very powerful tool to leverage your position. And when the fear spikes, that's kind of when I sell puts. And when the price dips below my average cost, again, I'm looking to sell puts. Now, you can do two ways, either buy the shares or two. Option B is to sell puts below my average cost or your average cost basis. Where selling puts, it lets me get paid for waiting. I'm getting those premiums. I can reinvest those premiums. I'm also lowering my cost basis, same way as buying shares. I'm also acquiring shares at discounted prices. And also doing this strategy, you stay disciplined instead of emotional. Now, I'm dollar cost averaging. Now, I'm okay with owning the shares of Webull at $9, for example, but I'm not going all in. I'm only selling one contract at a time and just lowering my cost basis. And then if I get assigned, I could sell covered calls, which I didn't really go over in this video too much, but it works the same way, but you want to be doing it when there's a lot of euphoria. And if I don't get assigned the shares, the premium goes right into my pocket, reinvest those, maybe even buy shares, maybe even use that to buy shares. I actually did that with HIMS itself. So we could see that I sold a covered call, for example, and then with that premium, I ended up buying shares, or I bought one share and lowered my average cost. Even though I am still negative, maybe I'll do it again if I sell another covered call. But that's how I stay active without chasing anything. And that's it. That's the whole rule. I only buy when there's fear, and I only buy if it's below my average cost. I'm not guessing the bottom. I'm not predicting anything like the Fed rate cuts or anything. I'm not trying to time every move. It's just a simple, emotion-free system that keeps me disciplined and helps me build positions I actually want to own. If you found this video helpful, drop a like, comment your average cost of your favorite stock, and I'll catch you in the next one. Peace.